And now we're looking at financial reporting comparability and accounting-based relative performance evaluation in the design of CEO cash compensation contracts. And this is from NAM in 2019. So what this study examines is the cross-firm differences in financial reporting practices and how that affects peer firm accounting information, and it's used to evaluate CEO performance. So here we see again the peer firms, the benchmarking, and the CEO performance, along with the financial reporting practices. And here we note that boards reduce the information processing costs associated with differences in firms' financial reporting practices. So again, that information processing, which we got the usefulness of financial information from our seminal works. So here they're looking for an optimal incentive scheme, and we see that they're again looking to benchmark in CEO compensation contracts, and we've seen that in other articles within this segment. And they're basically investigating whether RPE contracts and boards take into account financial reporting compatibility. And they're studying the ways in which they could employ these financial reporting compatibility to improve the documenting of the use of accounting-based RPEs in CEO compensation contracts. So basically they're adding now board of directors as another variable in this, and then they also show other research which includes board of directors and how the boards choose the peers for their CEO performance evaluation in terms of financial reporting compatibility. And here you see some of the same factors that we've seen, which is CEO compensation structure and the CEO total compensation as well. And in the Lit Review, they are strongly support the role of accounting data in firm performance evaluation and managerial compensation. And then we see D. Chow and Sloan, 1991, which is also an article that you've probably seen before and of importance right here. And then we also have Holstrom, 1979, which you've seen before, Jensen and Murphy, which you've seen before. So just all these articles keep coming up. And here you see Holstrom, 1979, the informativeness principle implies that the performance measure is useful if it results in managers being compensated for the outcomes of their own actions and decisions, which would also lend itself to the agency theory. And then we go into the hypothesis development. They go into FASB, how the conceptual framework states that users are decisions involved choosing between alternatives like selling or holding an investment or investing in one reporting entity or another. And then we look at the hypothesis where boards use peer firms with high financial reporting compatibility in implementing their accounting-based RPEs in CEO compensation contracts. And we see obviously ExecuComp is one of the databases, all of the models that they're using, and they're also using financial reporting compatibility. That's another factor and kind of an additional contribution of this article. And then as we progress on here, it goes into the design and we see the sample, right? So they're looking at S&P 1500 firms from ExecuComp during 92 to 2013. And basically then they go into a data summary. TDC1 from ExecuComp is total compensation, and they're looking at the cash paid portion of the CEO compensation, which is about 53%. And then they use the CEO cash compensation as the dependent variable known as pay, and the relationship between accounting earnings and cash compensation is more substantial than the relationship between accounting earnings and stock-based compensation. So that's an interesting finding. They're showing that earnings are more correlated with cash than they are with, or more substantial with cash than they are with stock-based compensation. And then the hypothesis predicts that the use of peer firms' accounting performance is likely to be significant when you're determining the CEO compensation when the selected industry size peer firm has high financial reporting capability. And then they also look at CEO turnover, which we've seen in another article. So hopefully you're making those comparisons in your response in your comp exam question. And then we continue, and basically because we're trying to summarize and you want to look at the conclusions, right? And so they tell you all of the prior studies, and then they tell you what they've come up with. And the results suggest that disregarding financial reporting compatibility when selecting RPE firms limits the ability to detect the use of accounting-based RPE. So they find that highly compatible peer firm accounting measures provide incremental information useful for the CEO compensation contracts. So hopefully and then here we do have all of the variables that they used, and this might help you when you're kind of coming up with variables to test if you're thinking of doing CEO compensation. So I hope this helps, and thanks for watching.